So, say you want to get started with this investing thing. You might have some money saved up. Maybe you have heard something on the news about Tesla, Netflix, or Amazon. And if how you'd invested 10 years ago in Tesla, you'd be a millionaire by now, or something along those lines. However, if you're new to the game, investing can appear to be very complicated. For example, how do you purchase a stock? What exactly is a stock? How does it work? Do you just go to tesla.com and buy some Tesla? There is the fear that we all have that investing is risky and that I will lose all my money. In light of all this is the definitive guide to getting started with investing. It's the video I wish I had when I first started investing in stocks and shares 5 years ago. And we'll do so by thinking about investing in 10 different bite-sized chunks. So the first is to completely disregard investing and simply consider what happens to my money over time. And if you studied economics, you'll know that money depreciates over time because of something known as inflation. In general, inflation ranges between 2 to 2.5%, and as a result, every year things cost about 2% more than they did the previous year. For example, in 1970, a cup of coffee in America costed 25 cents. In 2019, however, the same cup of coffee costs $1.59. That is inflation at work. Assume you have 1,000 pounds in your hand right now, and then you just put it under your mattress for the next 10 years and you never look at it again. In 10 years, your 1,000 pounds will no longer be worth 1,000 pounds because everything will have increased by 2% per year. As a result, the value of your money will decrease. We don't just want to avoid losing money, which is what our 2.5% rate does. We do want to make money. That brings us to the question, which is how do we actually make money? Let's return to our fictitious savings account. If we could hypothetically have a savings account with a 10% interest rate, that would never happen because it is far too high. But if it did, it would mean that we would earn 10% of the value of the money in our savings account every year. So, if I put 100 pounds in a savings account right now, it would be worth 110 the following year. Most savings accounts in the UK and I imagine the rest of the world now offer less than a 1% savings rate, which means you're still losing money over time. But we do have other options to get to this magical nirvana of, this 10% saving thingy. This is where investments come into play. In most developed countries, there is a general upward trend in house prices. Real estate is something you will be looking up for investments. You put it for a rent, and after a decade or so, when the real estate price hikes, you can put that for sale. And voila, you get profited from the rental income, but you have also profited from capital gains. But for that, you must actually own the house. You simply sort out rental management, rent it out to people, and so on. If only there was a way to invest without A, having a large sum of money to begin with, and B, having to put in that much effort to manage the assets as well. This brings us to the topic of stock investing. But before we jump into that, the sponsor for the video, book Love, Empathy and Project Management. The book offers a unique path into the world of project management. The link is in the description. So buying shares is probably the closest we'll ever get to this magical savings account that simply returns a certain amount of money each year. And the idea is that when you buy a share, you're purchasing a portion of the company in which you have a stake. A company you have invested in gains profit and wants to share it with the shareholders. Saying the other way, the company decides to pay out dividends. This is one way you make profit. The second method of profiting from stocks is similar to that of real estate, in that capital gains are realized over time. And at this point, you're probably wondering how much money you'll need to get started or how risky it is to buy stock in a company. But first, how do you buy a share in the first place? Earlier, we used to call Bob. He would then type stuff into his computer or a place like a paper order, and then you would own Apple stock. Thankfully, we no longer need to speak with Bob because there are numerous online brokers available. So you open an account with an online broker and use it to purchase stock in a company. Now the question is, how do you decide which stocks to buy? And the simple answer is, you don't want to figure out which stocks to buy. You do not wish to purchase individual shares. Stock market is risky. The company rising today might fall in the future, and based on its present performance, you just cannot contemplate its future. As a result, index funds are the best, safest and simplest long-term investment strategy for the majority of people. But what is an index fund? So there are two parts to understand here: the index part and the fund part. Let's start with the fund part and also the fun part. And because a fund is essentially where investors pool their money, multiple investors would invest in the same fund. The fund would then have a fund manager. The fund manager also decides which companies the fund will invest in. The index part now refers to a stock market index. As an example, a stock market index would be the FTSE 100, which represents the top 100 companies in the United Kingdom, or the S&P 500, which represents the top 500 companies in the United States. And if you look at the S&P 500's overall performance, you can get a general idea of how the US economy is doing. So this is how the S&P 500 looks right now. And if we do a 5-year time horizon, let's go all the way. As you can see, the S&P 500 began in 1980. And this is what the US stock market has been doing since then. To begin with, index funds are extremely simple to invest in. A common issue that new investors face is, how the hell do I know which company to invest in? How do I interpret a balance sheet? How do I do any of that? You don't have to worry about anything if you invest in an index fund. Second, index funds provide adequate diversification. The S&P 500 contains a diverse range of businesses. So you're not entirely reliant on the technology, oil or clothing industry to make majority of your money. You have a very well diversified portfolio of US companies. Fees for index funds are extremely low because it is not a real person deciding what to invest in, doing all this research and trying to make a lot of money. It is essentially a computer algorithm that automatically allocates your money based on the index fund's components. These have extremely low fees. Okay, so we solved the problem of deciding which stocks to invest in by completely avoiding the issue and instead investing in index funds. The next major concern that people have when considering investing in stocks and shares is the level of risk. When you mention investing in the stock market, your parents will tell you that it is a very risky investment and that you should invest in real estate because it is safe. That is typically how people think about investing in stocks. And of course, there is a fear that I will lose all of my money. So let's get started on that right now. So taking a step back, the only way to lose money in anything is to buy something and then sell it for less than what you paid for it. You buy a share. In a couple of days, its value decreases. You panic. You sell that stock at loss and call it a day off. But have you waited for a couple of months? You could have got good returns. Ideally, you should not invest in stocks or shares that you need to access within the next 5 years. In fact, many people would extend it to 10 years. To begin, make sure that all your high interest debt, such as credit card debt, is paid off, because when it comes to compounding, losses compound alongside gains. The second point is that you should set up an emergency fund. And people usually say that your emergency fund should have 3 to 6 months of living expenses in cash, so that if you lose your job or have some kind of incredible medical emergency, hoping nothing happens. Furthermore, you're not required to withdraw funds from your investments. Making the account, researching online brokers in your country, and figuring out how to do this stuff is the most valuable thing you could do with your time right after watching this video. You wish to locate an online broker, so this will vary greatly depending on which country you are in, because these online brokers must comply with zillions of laws and financial regulations. Most people I know in the United States use the Vanguard as well, although there are other services available in the US, such as Betterment. Again, depending on which country you are in, literally all you have to do is Google the phrase best online broker Germany or best online broker India. Basically, the thing you're looking for is you want to be able to invest in index funds and you want the fees to be as low as possible. Then, after you have created your account, verified your identity, and gone through all the hoops and stuff, you can begin putting your money in here and there. At the beginning, you might feel like looking at your portfolio every day, maybe a number of times in a day. But slowly, you realize that the investment is for long term and you stop doing that. There's a lot more to say about investing in finance, but hopefully this was a reasonable, if not particularly concise summary. This is going to be a long video, but hopefully it was a good introduction to how to start investing in index funds. Thank you so much for watching. Good luck with investing. Hopefully I'll see you in the next video. Bye bye.